Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at MacNicol & Associates Asset Management.
Great. Thanks very much, everyone. Welcome to January. So just an update with 13th Floor. We're in quite a few of their LPs. I'll give you a breakdown of each one, and then we'll get into charts of the week. The disclaimer is designed to draw your attention to the fact that we're not providing investment advice directly to you in this presentation. Beginning with Fund 3, we were in a number of the 13th Floor LPs. Funds 1 and 2 as well. Those have concluded their investment periods and have returned money to limited partners. Funds 3's breakdown as of the end of Q4 25 is as indicated on the screen. It's mainly developing homes. So they have a number of subdivisions they're doing just north of Miami in towns like Tamarack and others like it. This next slide just gives you a breakdown of the life-to-date capital activity. Fund 3 began life in 2016 and in or around 2020, so just before COVID, just after COVID, transitioned from negative to positive, and life-to-date contributions at 35 million versus 50 million distributed back to LPs, including the preferred return. So some decent work there. And then these are the multiples coming in at 2.9 gross and 2.4 net to the LPs after fees and carry. Fund 4 is as indicated on the screen as well. A little bit more in the way of commercial real estate and condo development here. There's a couple of huge towers that really just by themselves kind of bulk up that condo number at 15%. But certainly, no question about it, multi-res continues to be the way to go, regardless of what firm you're talking about. Fund 4's capital activity started off life in 2021, and you can see the capital commitments outweigh the amount distributed back to LPs, and that's going to lead to a 0.7 multiple. And this fund is still very much kind of in the meat of its investment process, probably maybe two to 3 years left yet to go. And again, you can see the net and gross multiples on the screen. Fund 5, this is the latest fund. Again, very much the case that they are into residential real estate. This one's got some mixed use assets as well and condos. But if you actually drive up into Fort Lauderdale on the roadway into the marina there is a sign stamped into the ground that says 13th Floor Home. So they actually have their own home building division and are selling some of their finished product to some of the larger publicly traded players in the space. So that's Fund 5. Fund 5 began in 2020. Is still drawing capital, not yet distributing the proceeds of sales back to LPs just yet. And so these are projected multiples, not actual ones that have been realized. This is sort of a cross section of pretty much all of the 13th Floor portfolio, sort of separated into what they call successful and superior multiples. The pictures up top are intended to go from right to left. So kind of the opposite of what you would see when you read. So on the far right hand side of this, that is going to be the link at Douglas Station. So I only was able to put the first 9 properties from the superior category. So again, 5.1 times is going to be the link at Douglas Station. The one in the middle is Hallandale OZ, and then the one on the left-hand side of this particular slide is the Mount Auburn multi-res portfolio. That's about 880 units, and there's a couple of individual buildings. That's sort of the main snapshot of the property. On this page, we have Hidden Trails. We've toured that community. It's great. And then the plot of land there representing 36 Collins. It's kind of a funny shot. This is a development place, so there's going to be a condo there right now. I haven't driven by this plot of land in a little bit, but It is beachfront property, so that was quite a pricey bit of acreage, but it's going to be developed into a really nice condo. So that's 36 Collins, and the double condo on the right hand side is 400 SI. I forget what SI stands for. It does stand for something. That is a live asset, and I think there's three more that I shared on this slide. So 1010 Brickell is one of the flagship office towers in downtown Miami. On the trail is a development community, and then Sereno at BH is the last one there on the right hand side. And then just in terms of acquisition, groundbreaking, and disposition activity, these cold storage assets and a lot of logistics assets, I think on the disposition side are moving still reasonably well. So you did see some sales in terms of the cold storage asset in Fund 4 as well as Marina Landings. The other properties are kind of at various stages in either acquisition or groundbreaking and development. We've been a supporter of 13th Floor for a little while, and they are getting it done for our investors, which is great. SOT strategies. So I think Andrew came into this edition of Charts of the Week. I'm just sort of pointing out the fact that really there was a little bit heavier selling on Wednesday, and it ended up breaking down through the lower but upward trend line of a wedge pattern, and potentially signaling a bit of a breakdown. And thus far, it really hasn't transpired. And again, one of the things that Andrew, I think, does exactly right is he doesn't get overly fixated on an individual technical indicator. If anything, prompt him to ask more questions and look for corroborative evidence from other indicators, as well as sort of the overall broader fundamentals of the market. And he certainly integrates fundamentals into chart following. Right now, he's sort of at the position of this was just sort of a shot across the bow. It's much too early to determine whether this is going to result in dip buying or selling into strength. So let's take a look at the charts. So it's kind of hard to see, but if you go to the upper right hand side of this chart, there it is right there, the breakdown through the first standard deviation above the 50-day moving average of the S&P 500. This has happened before, so it's not really, it's something. I wouldn't say it's a great big nothing burger, but it's sort of a minor blip lower. So it's really, like he says, much too early to draw any conclusions. And that's that upward trending, sort of falling through that level that he talked about, the rising wedge. And traditionally with these rising wedge patterns, if you break down through the lower upward trending line, they can create fairly swift kind of corrections. But once again, it's extremely early to make that kind of statement. And that sort of caution around, is this a problem, is supported by the fact that other indicators really don't point to that. So the S&P geometrically weighted index here is actually at all-time highs. So this is certainly, a check mark in the box saying, this is not really much to worry about. Also with small caps, you can see the Russell here punching to new highs, actually on pretty good momentum here in the lower panel. So that's not really an indication of people running for the hills or anything like that. The problem, I think, that we should maybe just kind of take a look at a little bit more closely is this these financials. So this is the XLF, the so-called financial sector spider fund, and the banks have gotten off to a bit of a rocky start. Jane Fraser's been in the news just the other day about more firings at Citigroup and stuff like that. But the fact is, a lot of these banks got off to kind of a rocky start in terms of earnings, and that's really kind of dragged them down into this level where there is sort of an intersection between, I believe, the blue line is a 200-day moving average, as well as this green support zone. So excuse me, that's the 50-day moving average. I apologize, but it's taken it back to this important pivot region, as Andrew calls it. And who knows? Maybe people will use this kind of sell-off as an opportunity to load up. Looks like that lower panel, the RSI, is kind of fading. So potentially, if that turns, flattens, and starts going back up, you might see some money coming into financials, but I'm kind of dislocated from financials, so I don't really know what the banks are up to. One of the areas that we really haven't talked a lot about on these calls is consumer staples, and they've really sort of popped up here out of nowhere. Someone who follows this area, feel free to opine. I completely have not been following consumer staples in like a couple of years, so I certainly can't tell you what the fundamental reason for it is. Traditionally, with consumer staples, you do get into those when there's sort of a, you know, kind of a risk off type of mentality in the markets. So people may be taking money from consumer discretionaries and buying Clorox and companies like that, but we shall see. And then copper has really like soared, so to speak, and it's the miners that have really benefited. So the copper miners are going to be that lower panel, and you're really seeing Dr. Copper take the stocks higher. Mining in general, I think, has been huge, whether it's copper, nickel, zinc, silver just reached a new all-time high last night. And of course, rare earths and critical materials have been pretty much front page news ever since China put on export bans. And so very, very interesting developments in other materials. Most recently tungsten, which kind of took off like a scalded cat, as the expression goes, but also, you know, other materials like palladium, gallium, and antimony. Bitcoin, you know, Bitcoin has been, as he says, conspicuously, quote, dead in the past couple of months. And, you know, I'm sure probably Sean, you would have some better perspective and insight on this. But technically, Andrew is indicating that this is a potentially low risk entry point for a short term trade. And BTC hit its head around 94,000 on a couple of occasions, as I'm sure you all know. But the recent action does have this sort of cup and handle pattern. Andrew really likes this pattern. It gets mentioned, you know, every second or third edition of Charts of the Week. So he just obviously has a lot of faith in this pattern, but it does imply a move to over $100,000, which is the next major resistance level, which is good because we do have a little bit of crypto and blockchain exposure, but certainly not through the direct holding of the applications, either layer 1 or layer 2. And then just finishing off, you know, pie in the sky versus the S&P 500. This is an interesting chart because he's essentially comparing and contrasting global markets to U.S. equity markets. U.S. equity markets, obviously, for the last you know, little while have been star performers. This chart, which shows sort of pie versus the S&P 500, not only in the upper panel breaking out from its kind of longer consolidation period, but also on a comparative basis outperforming the S&P 500 below, indicates that potentially things like valuations in U.S. equities are causing global investors to look at other markets. And I think that's it for me, Dave. Thanks a lot.
Okay, thanks, Joe. Ken, you ready to go?
So I'll just show the same disclaimer as Joe, and then just US one at the front end as well. I'll be pretty quick on these front end slides. There's no changes really. No box change here on the S&P. Obviously a bit of a rocky week with a couple things coming out. Wall Street earnings, the CPI report yesterday, a new feud between Trump and Powell. Obviously, the December CPI report shows a bit of sticky inflation, but still kind of moving towards that target of 2%, but still well above it. So indicating probably no short-term cuts. Obviously, overbought, oversold 29%. That's a slight decrease. And over the last 10 weeks overall, as a trend, it's been pulling back as the strong demand, especially in large cap US equities, has slowed. I think that's a lot to do with valuations and concentration and investors rotating capital out of really I'll say the one major theme that has done the best over the last few years being US tech. Looking here at the NASDAQ, similar story, no box change week over week. It's now down year to date to start the year and at the lowest point it's been at since December 17th in a month. Negative years actually, which is, it's only been 2 weeks, but negative years for most of the Mag 7 except for Google. And interestingly enough, non-NVIDIA semiconductor companies are actually having a very strong year while NVIDIA doesn't. It is at resistance here on this chart. Momentum reversed on a monthly basis. It is approaching the 50-day moving average from above and about to drop below. And then the overbought, oversold kind of just highlights the overall recent weakness of the NASDAQ. About 8% overbought, which is still positive, but a massive decrease over the last few weeks. As I mentioned, tech demand seeming to screech to a halt. And it's been screeching to a halt over the last 9, 10 weeks since the end of October. Looking here at the Dow Jones, I didn't replace the picture, which is on me, but overall 3 column changes. It moved down 3 boxes, so it's sitting at about here. It has created some strong resistance to start 2026. It's not on this chart, but the strongest start to the year seems to be a rotation toward more value names. Almost every non-tech component of the Dow is up to start the year, led by some of the industrial names and energy names, which is no major surprise. The Dow does have the strongest technical outlook of the US indices. Price objective is still very bullish, momentum bullish, overbought, oversold, remains very elevated. And even on a valuation standpoint, cheap compared to last year, not cheap when you compare to historical averages, but cheap on a relative basis also compared to the S&P and NASDAQ as well. I'm just looking here at the TSX 60, 3 box increase. The melt up continues. The commodities have continued their run this year. Miners, chemical, energy companies, really energy companies have done very well since the original reaction to Trump's arrest of Maduro. There seems to be a narrative of a flight to quality, safety, and a diversification away from U.S. equities, which is benefiting Canadian names. P, according to FactSet, moved up a little, but only to 22 times trailing 12-month earnings. Momentum looks strong. Overbought, oversold is the highest since October 3rd. You can see even when the US indices have showed some technical weakness in recent weeks. TSX 60 has actually done the reverse and shown even more strength. So continuing to watch that. Looking at the VIX here, about a 3% increase, 2 new buy signals this week. Target moved up to 19%, which is getting close to this trend line, but it has made some higher lows, which is pointing towards a trend that points to a upward break on this chart. So we'll have to watch the VIX in the short term. But looking at these bullish percentage charts, not a lot of changes, sitting in the mid 60s like they have for the past few weeks. Percent positive trend, same thing. Like I said, the Dow showing a lot more strength than the NASDAQ. And you can see their absolute moves in the past week. And then the Toronto Stock Exchange, no real moves over the last 2 weeks, but both still at multi-year highs with even more headway to move to the upside. Looking here, this is obviously the Daly. I'll be pretty quick on here because I kind of broke down the Daly on the next 2 slides. Not a lot of changes in terms of high level. Interestingly enough, energy slipped a little off the back of obviously some oil weakness. Even though oil's moved up in recent sessions, just on a relative basis, it's moved lower. Latin America continues to gain strength over the past few weeks. And then within domestic equities, healthcare, energy, and I think it's financials have all gained a substantial amount of buy signals over the last 3 weeks, while tech, communication services, and real estate have pulled back. So you're seeing potentially a bit of a rotation toward what some would consider some of the not necessarily safer because of energy, but some of the we'll call them necessity sectors, and rotating away from the more expensive tech, communication services and into more value oriented names. But we'll have to watch up here in the size and style rankings if value can reach above that. And here you can see over the past 9 to 12 weeks, I think it is, the trends in buy signals. Tech's lost 20 buy signals, communication services down 14, industrials up a little, basic materials not surprisingly up pretty substantial amount, with the price of copper and silver continuing to move higher. But you can see the real roar here with healthcare and energy, which have really gained some steam in recent weeks. We think that trend could continue. Obviously, energy names in the US really have benefited from the Venezuela news, but we'll have to continue to watch that. And then this is just a chart that Dorsey Wright published at the end of last week. It tracks the short and long-term strength of the Daly sectors. So that chart that I was just explaining, and you can see up here, it tracks short-term and long-term. The short-term is the vertical axis, the long-term is the horizontal. You can see strong and advancing up to the right, and then you can obviously see where each sector sits in this area. They have noted that energy and healthcare have made the largest moves in the last few weeks, which is not surprising. but basic materials over the past few months has made a substantial rotation on this chart. Just looking here, this is the NASDAQ crypto index. I don't usually cover crypto, but interesting chart to start the year, just tracking the largest crypto constituents in the NASDAQ crypto index and their year-to-date performance. A strong year to start over the last few weeks. And you can see some technical data points here for the likes of Bitcoin, Ethereum. And interesting enough, even with these strong year-to-date performances, the weekly overbought, oversold, really not heavily overbought for any of the cryptocurrencies. So potentially a sustainable move that these cryptocurrencies have had to start the year. Kind of back to stuff that I usually talk to. Looking at Colombia here, this is a Colombian ETF. We do not own this. We've talked about Latin America. We have liked the Latin American region for a long time, not really because of Colombia per se. We've liked other countries, obviously Mexico, Brazil, and Argentina. But Colombia, one of the last countries that's very, very, I would say, left-wing in Latin America. And there's been that rotation from left-wing to right-wing governments in recent years. You can see, obviously, the biggest example of that is Argentina, their huge turnaround. But Colombia has an election on May 31st. We've seen a surge in the Colombian ETF last year, but we have seen a bit of a pullback, and it has created some strong support, which could create a nice entry point. Colombian equities are really cheap on a PE ratio. And if you're comparing apples to apples, Javier Milei won the Argentinian election in October 2023. This is the Argentinian ETF. Stocks have more than doubled in Argentina since. I'm not saying there won't be volatility. You can see the drawdowns on this chart over time from $40 in mid-October 2023 when he won to January 2026 to 92. It's more than a double. And the polling, I will say, in Colombia points to more of a right-wing government. I think they do one of those ranked ballot systems, and even when it's one-on-one between that candidate and I think the incumbent party, that candidate is supposed to win. So if you're betting on another Latin American country to make a change, potentially a trade there to make in the short term with the election coming in at the end of May. Looking here, this is battery manufacturing investment by country or region. China obviously making a chunk of it, 71%. The US and Europe only accounting for about 21%. You're obviously getting a focus on these critical industries from Trump, and you're getting these massive investment pledges from institutions and even the government in the US. We expect that to continue, and obviously investing into companies that will benefit from the growth of the battery and the various critical industries within the US will be a very smart thing. I just had no clue that even today that chart was so skewed toward China, obviously, in terms of geopolitical issues that could pose a serious threat to the US, but even more so Europe, who have kind of filled the void that the US have left with their decrease in trade with China this year. Joe mentioned it, silver, top $90, it topped $92 an ounce yesterday. It was up 6% yesterday, up 25% year to date. Gold is near record highs. Industrial metals obviously doing well, copper, tin, and they're both ripping. The rally obviously been driven by a number of things. China continues to limit exports. They're reducing production and loosening monetary policy, which is increasing the consumption from China. And there's also the fact that silver demand has exceeded supply for 5 straight years and is forecasted to do so again this year. I think there are more investment demands in terms of a flight to safety, diversification, all of these institutions, individuals being so under allocated towards precious metals. You're really getting this, I don't want to say silver squeeze, but you're getting a lot of velocity in the movement for silver. And it's playing catch up relative to gold, I think, right now, and that will continue. Looking here, this is the copper deficit highlighted by Katusa research. You can see the last few years, the copper deficit and it's forecasted to expand. Why is that? AI demand. Data centers are adding applications for copper. A typical 100 megawatt data center that costs around $1 billion will demand about $60 million in copper. This research was done in December, so the price of that copper will more than likely be much higher than that for these institutions that are building these data centers. Could be one of the trades of the year, obviously, with the increase in demand we're seeing in copper. And here, this is from the S&P Global, published by the Financial Times. This is the demand and supply forecasts for copper moving forward. And you can see the correlation from 2020 to 2030. So we're going to see a small, obviously, demand outstripping supply, but kind of beyond that, because there hasn't been major discoveries, there's going to be a even wider spread there, which could lead to massive increases in the price of copper. This is just a quick chart that I read in a quick newsletter that I found interesting. It was from an American. I'll try and look for it and just forward it around. But they basically highlighted the just the lack of efficiencies and production within Canada in recent years, and use this chart to talk about why that's happened and their lack of investment in CapEx. But you can also kind of correlate this chart, the red, to when Canada was heavily investing in expanding their oil sands and the CapEx required there. I mean, the chart basically turns down. It is a bit of more cyclical, obviously, with the nature of the Canadian energy industry, but basically turns over with the election of Trudeau. And that's, I think, the one thing that's a concentration in the energy industry, obviously, has helped Canada in the past, but also be hamstringing it, obviously, in the long run, and not investing into other critical sectors, obviously a big issue. And then just, I think this is my last slide. This is just 5-year for Japan. Basically, it's at its highest point right now since 2000. 30 and 4-year yields hit their record last week. Why is that? Market is pricing in debt issuance by the new government, which is likely to call another election because of favorable polling results. So from what I read, I think they'll get more seats and they'll be able to push more through. And apparently they're going to finance an even larger expansionary fiscal agenda, which obviously will push yields higher. Last year, we kind of talked about the Japanese yen carry trade being blowing up. This year, it also, because Japan is the most indebted government in the world, it might be something else. And it might cause, obviously, the Japanese government to have some serious fiscal issues, especially down the line if this expansionary agenda is put in place. And I think that's it for me, Dave. So I'll pass it over to you.
Doesn't the current Prime Minister of Japan have some kind of like a 90% approval rating, or is that some person coming in?
No, I think that's her. That's why she's
incredible.
She's the current prime minister, president of she's the current leader of Japan, and she doesn't have to have an election, but she's doing one of these snap elections because apparently she'll gain even more seats and support.
Yeah, like, but looking at that chart there, and you got a typo there. That's 5-year highest point since 2005. Yeah, but that's incredible, and how the population thinks that that's a good thing. But I guess they're trying to stomp out inflation, and maybe she's being smart about it that way. Okay, so back to Michael Coolbaugh, and I've got his performance results for last year as well that we'll take a look at in a moment. And he's a macro investor, and I think has some excellent macro outlook. So here's something on oil. While product prices pass through tend to decline, raw material inputs tend to decline by a greater amount. Good for margins. A warning for semiconductors. Renmac issuing a warning for semiconductors, which is pretty interesting given what I'll share on the next page. Didn't see that on Taiwan Semiconductors chart, but maybe it's getting toppy. That analyst did state that. Emerging markets, which we have an interest in. Since President Trump's inauguration, it's been a one-way trade in favor of emerging markets over the United States. Makes you wonder about the America First policy. Sure, some of his currency impact, US dollar has fallen, but this probably surprises a lot of people given all the excitement, promises, and insanely bullish predictions surrounding AI. Yeah, just some consolidation going on here, but a bit of a breakdown. So we'll have to keep an eye on that one. Investors underexposed in China. And despite this significant outperformance, investors remain drastically underexposed to the largest emerging markets stock market in the world. Well, there's good reason for that because there's no rule of law in that country. And yeah, a little hard to make way there, whereas many of the other emerging markets do have a rule of law. China large cap again. After a short-term consolidation back into its 200-day moving average, we just received an acceleration buy signal as China looks to break out again. Okay, it's in a downtrend, but it looks like it's breaking out of that downtrend. Not interested. We're not going to be investing in China. Investors underexposed to cyclicals. Yep, that's bad for them, and we are overexposed, which is good right now. And here's some individual companies. Marathon Petroleum became oversold just below its 200-day moving average, but quickly recaptured strength. If we can clear this resistance above 183, it raises the odds of continued upside momentum. So there is an oily name, Valero, one of the refiners, Valero breaking out to a new all-time high. We've seen plenty of volatility around energy names over the past 2 weeks, but if we can hold this breakout, I like the potential upside potential. Chevron has been stuck in a miserable grind lower over the past 3 years. With its strong presence in Venezuela, it'll likely be the biggest beneficiaries of any renewed activity. Yeah, so it's broken out of that long-term downtrend. Exxon tried to give a head fake on the first attempt at new all-time at the money, but this week's move seems to be for real. We'll see if we can close the week at a new high. Now, the Exxon CEO, I believe, said that he thinks that Venezuela is uninvestable just due to the type of oil and the stickiness of that oil, much like our oil sands in Western Canada. And I think he also means just the amount of corruption that still exists there. So we'll see what happened. Trump didn't like that at all, of course, anybody talking against him, but we shall see. The Dow Inc., another chemical company, one of the many chemical names that fully looks to be making a bullish turn. A lot of these are heavily overbought, so I'm more interested in waiting for a pullback consolidation. I don't know how he can say it's heavily overbought after such a down period like that. So we're going to be speaking to him shortly. Nutrien, which we own. Yes, even agricultural chemicals can benefit from lower petroleum prices. Nutrien is just one, but others include those symbols, Mosaic, and several more. So yeah, we'll see that. Now, Louisiana Pacific Lumber Company stand to benefit if the Trump administration incentives increase home building activity. Yeah, so that's trying to break out. UFP, similar to LPX, you'll notice how a lot of these building material names had false breakdowns below, given how little interest investors have in housing. This is another appealing contrarian trade. Okay, yeah, that's big breakout there. Owens Corning, I don't love the love that OC is trading below its downward sloping 200-day moving average. But similar to lumber names, it had its own false breakdown. OC is one of the best run companies in the building materials space, and multiples are attractive here. Yeah. And that's it. So some good information there. Michael Coolbaugh's results last year up almost 13%, over 30% since that's straight line since inception. And for a macro investor, I think he's done a good job here. Volatility inter-month isn't great, and he does tend to get some outside. Like in April of last year, he did a good job there when the Trump tariffs were coming in. Joe and I will be meeting with him. It's very tiny though, only 4 million. So I'd like to see him get some more assets in there to make this more of a real fund. So we've taken a bit of a risk being with him so early, but we've known him a long time, even back in his Real Vision days, where he did some work with us, helping us with some Real Vision videos. So great guy. Okay, morning coffee just came in, so I have not read this. And as we are early in the year, I'll just do a quick look at the year-to-dates. So only thing that is red is India. That's unfortunate. We just entered into a weighting in India, Fairfax, India.
It's very hard to buy unless you're a retail investor. So we managed to get a position, and yeah, lots of good things going on there, and we'll hear more about it at the AGM in April, both Fairfax AGM and the India Fairfax AGM. So we shall see. We just feel that India does have some great growth prospects, largest population in the world, rule of law does exist. Sure, there's lots of corruption there. There is in all of these more developing economies, but I think the growth rates there will be larger than we'll see in North America. Okay, so that's it for the markets. The commodities, Ken's covered, and Joe as well, really well. Crude is all green there, so that's a big change, I should say, with that 10% weekly. And nat gas is still suffering. Gold continues to shine, and silver is just astronomical. Look at the 1-year number there. So something's going to happen. We should probably be maybe cutting back on some of those. I hate to say, because they're not going to go forever. And copper, was a great chart, Ken, on your copper, and just the supply demand is just way out of whack there. So you're seeing the price adjust. As always, Canada US dollar, I'll cover on point and figure. Ken's already done Bitcoin, and interest rates, I'll cover briefly. And finally, back to just the playlist to finish things off, the playbook. So no change for our Canada US dollar. I see it was Canadian dollar appreciated 5% last year to the US dollar. It didn't really impact or hurt our US holdings materially. Held back our alternative trust, which is mostly a US dollar, a little bit, but both the short term and the long term indicate lower for our Canadian dollar relative to the US. So we shall see with the ICE US dollar spot index against the world. It looks like it's about to turn and start to move back up again. So yeah, I think all the work that Trump's regime has done to push it down, it might be at the end of its time here. And that's also had that's had a lot to do with the rise in precious metals and some other commodities. Yeah, so there we are in 2025. It was at 110 peak, and it bottomed out at 96.50. That's about the same amount of downside that happened in 2017 in Trump's first term. So it looks like it's going to be going sideways here, and then the mathematics of point and figure, which are not always accurate. They're not 100%, nothing is, but it does show a trend back up again. Okay, that's it for currencies, and a lot of them there that we follow. Okay, so crude oil still measures down, nat gas down. The producers measure up a bit. Copper measures down, surprisingly. And uranium, big time up. Gold continues to look like it's going to go higher there, including the spot index right around the same. The gold bug's up. Yeah, everything's up in the precious metal space. Silver, though, this is what I was thinking just intuitively there, at $91 measures down to 79. So it might be peaking out here. And like I say, it might be time to take something off the table there. It's great to get some gains in the books at the beginning of the year. Then you know what you have to work against towards the end of the year if you have any losers. Silver flat as well for the juniors as well. So platinum, I was out with a fund manager down in Florida recently, and he's got a massive position in platinum, feeling that it's still very much undervalued, although point and figure would disagree with him. But look at that year to date. I believe that's for this calendar year. Yeah, that probably is 16% for January. Bitcoin still has this crazy upside of 226. It's already trending there at 10% up. I already covered all of these. So all of the cryptos are having very strong starts to the year. Solana points down, as does, Ethereum. Bit of a mixed bag there, according to point and figure. Canadian banks look very strong, 58 up to 103. U.S. brokers strong. The U.S. banks, the big boys, measure up big time, and so do the regional banks, which we now have a position on in a regional bank specialty manager, and we should start to hear headlines more about consolidation in that space. So same thing here. The 2 years at 3.5 measures down to 2 3/4. The 5-year measures up. The 10-year up, and the 30-year down. So we're getting this sort of a parabolic curve. Yeah, but this is good news that maybe inflation is coming off a bit. I don't think it's been, it's not down to the 2% level that the Fed would like to see it at. Although David Rosenberg did some good work and saw that he thinks that they have met the 2% target. So it'll be time to get caught up with him shortly. And that is it for me.
Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit MacNicolasset.com to learn more.